So as we know at this point, indicators are extremely important in technical analysis and giving us the complete picture with little clues to the puzzle. And we're going to be looking at these indicators from a bearish standpoint. So again, it's a little bit difficult for people to get over the initial hurdle to be looking in the opposite direction, but it's essentially, imagine it if you were in a bullish position, every single red flag that would be whether it's volume or RSI, every red flag for a bullish position is going to be a green light for a bearish position. So we're going to look at history, looking back at what has happened in the past to give us some clues as to what is most likely to happen in the future. Of course, the RSI and my general rule of thumbs that I stick by on when will go bearish or enter a position or when I'll pass it up. Volume is always important, and we're going to be looking at exactly the opposite of what the bulls want. We want to see decreasing bull volume and increasing bear volume. And of course, the overbought climax, which has gone really well in the cryptocurrency space, which is a combination of volume and overbought RSIs to indicate that we are likely to pull back in the near-term future. Looking at previous history can give us information on what is more likely to happen in the future. And a couple examples of that are recognizing patterns. This is the dump clock that we were watching for a couple weeks back in early March. And it varied in terms of time, but there was a window of about a couple hours where day after day, we would see high bear volume come in and a big flush. And that volume stood out very clearly on the shorter term timeframes. This is showing it on the hourly chart. But you can see day after day, whether it's 11 or 10:15, 10:15, 11:15, then it started to vary a little bit and getting more on the outlier side a little bit later afternoon and then a little earlier at 8. But the bottom line is we noticed a pattern with high volume bearish action in this morning time after time. And if you were able to recognize that and play bearish, knowing that playing bearish in this certain time frame increases your odds of a successful trade. So obviously it's not the kind of thing where you look at this and just say, oh, well, we dumped at 11 o'clock the past 2 days, so I'm just going to buy bearish. You have to see the setup that's there as well and maybe wait for the first support level to break to give you the sign, or an initial spike in bear volume on the 5-minute time frame to give you that sign. But it's definitely something that you can incorporate into your trading strategy, and not only just recognizing patterns, but of course, looking back historically at our indicators. So what has the RSI told us in the past? If I'm looking back historically, I can see on the 4-hour time frame for Bitcoin, since the all-time high, the RSI, the highest it has gotten is in the upper 70s, and that hasn't happened often. So I can say to myself, okay, if the 4-hour RSI on Bitcoin starts to get at 70 and just break 70, we can see it got to 72 here. It hit and rejected just from 70. So I can say that if the RSI on the 4-hour time frame is at 70 or higher, I can begin to look scaling in to a bearish swing position. And I say swing position because if we're looking on the 4-hour time frame, you need to have the patience to let the trade develop and to let that pullback happen from that RSI. And just looking back, not only on crypto, just referring to technical analysis, I'm looking at oil because there was a play here where the 4-hour RSI was above 80 just a couple weeks ago. And I looked back and I said, okay, when the 4-hour RSI gets above 80, how long does the price stay up there? And the answer over multiple years of data is not long at all. So we were looking at a bearish entry from that 4-hour overbought condition. Next thing you know, we pulled back for 6 4-hour candlesticks, 24 hours of straight pullback because that 4-hour RSI was over the 80 mark. So again, just an example with US oil, you can do this with anything, stocks, crypto, whatever. If you look back historically, you can get clues from these indicators on what has happened in the past. And if something has never happened in the past before, it doesn't mean it cannot happen, but it means it is certainly not likely to happen. So that's something that you can do looking back at history to get some clues on when to be looking for bearish positions. Going off of looking back at previous history, another thing I want to talk about is my general rule of thumb. And this is for stocks, crypto, whatever I trade. There are very few instances where I will break this rule of thumb. News is really one of the only factors. But what it is if the RSI is over 70, I do not look to initiate long positions. And if it's under 30, I do not look to initiate bearish positions. So if the RSI on the 4-hour time frame or the hourly time frame is already oversold, we know from our past and from our success trading oversold bounces that that's the time to start looking bullish. And there are certainly times where we see the RSI get overextended. So, if you made a bearish entry when the 4-hour RSI broke 30 and it pulled all the way back down to 20 on that 4-hour RSI, yeah, there would be a bullish trade to be had there. And you are going to miss trades and you would say, wow, I should have got in. But if you stick to this rule of thumb, it will over time keep the odds in your favor for making poor entries. So if I'm not going to enter bullish when the RSI is over 70 because I don't want to succumb to FOMO, it's the same thing in the opposite direction. If the chart is already oversold, the risk to reward of continuation to the downside is not in my favor. The odds that I'm going to make a solid profit from that already oversold point compared to the risk that we do see an oversold bounce is not high. So I will always factor that in, and it depends on the time frame in terms of what you're trading. If you are day trading, you're not going to initiate a bearish position with the daily RSI oversold, or I should say if you're swing trading, you're not going to. Same with the 4-hour time frame. Hourly RSI oversold, even then, if it's under 30, I'm not going to initiate a bearish position, even if I'm looking longer term. As far as day trading goes, if the 5-minute and the 15-minute are oversold, I'm not going to enter a bearish position. So again, it's just a general rule of thumb where I can be as robotic as possible to not give in to any of those emotions if I have that general rule. And it's a very simple process. You look at the RSI, is it under 30? If the answer is yes, you don't enter a bearish position. The next indicator we're going to be looking at is volume. As we know, volume gives us tons of clues as to what's going on in terms of the strength, which direction has more strength, as well as potential climaxes of bottom bounces and top reversals. So here we're going to be looking at the downtrend on Ethereum on the 4-hour time frame all through March, which has been a brutal month for Ethereum. But what stands out is obviously the solid downtrend of lower highs and lower lows, which is exactly what the bears want to see. But look at the volume. We have increasing bear volume on the dump. We see a bounce attempt. The volume on the bounce does not compare to the red volume. Still lower volume. We have a tightening equilibrium pattern. When the equilibrium pattern breaks bearish, it's a spike in bear volume. The bounce attempts are weak. They are not getting much follow through. They are rejecting from the 12 and 26 period exponential moving average resistance. Another dump, increasing bear volume, and you can just see that consistently it is the bear volume outweighing the bull volume, which is why this downtrend has been so brutal. So other indicators that we're looking at on bounces, this is the 4-hour time frame, but on the hourly time frame as well, when we start to hit these 12 and 26 period exponential moving averages, we often see opportunity for bearish entries. So on these weak bounces, let's see on the initial move down early March, you can see every little weak bounce. Again, the bear volume stands out. It's just a weak bounce, a lower high. We reject from exponential resistance. So not only can you be looking at the volume, but the exponential resistance can guide you. And the volume acts as sort of a confirmation. We can't get over exponential resistance. We see increasing bear volume. We know that the bears have continued control of this position. It's also looking at incorporating the history. So if I look at this dump on Ethereum and I can say, wow, the hourly RSI 30 isn't really that point now where we're seeing things get oversold. This RSI on the hourly is continually getting right down to 20. And that's just 4 times in a couple days span. So that tells me, okay, the RSI can get more extended because of how bearish we are on this individual name. So it's all the little pieces of the puzzle that lead you to know how long to ride a trade out. So, volume and the exponential moving averages aren't necessarily signals that you're going to act on to get into the trade. That's going to be more, breaking support or seeing patterns play out, which we're going to cover more in depth in just another section here. But it's the indicators and the volume that give you the confidence to say, okay, it's going exactly as the bears want. We're seeing the volume profile match the bears and telling us that they have strength. So we're going to stick with this trade a little bit longer. So again, these indicators are not telling us necessarily enter now. They're giving us the little clues that can help us, ride out the position longer or let us know that we're looking in the right direction, as that's where the momentum is headed. Now we're going to look at volume climaxes and how they give nice signals for the bears to enter overbought conditions. So this is an indicator that we have incorporated into our alert system. And it triggers when the RSI is a certain high level and the volume is accompanying that, because we often know volume climaxes signal the top of an uptrend or the bottom of a downtrend. And we certainly play those oversold climax bounces all the time. Well, bears look to play overbought climaxes, especially if we're in a long-term downtrend. So if the daily chart is in a downtrend and we see the hourly or the 15-minute time frame get to a point where the RSI is really high and we get that volume climax, we're more confident in a bearish position and we can hold that bearish position a little bit longer than, say, if the daily chart's in an uptrend and we see a volume climax. That's not going to give as much bearish opportunity because all signals are pointing bullish on the overall longer term trend. So it's definitely important to be watching what the overall trend is doing on time frames, even if you're looking for just a day trade and trading, a 15-minute or an hourly indication of making that bearish entry, the daily trend overall will be important. So here's an example on Litecoin, the hourly time frame. So coming from the bottom, we had an RSI down at 30. We started a bounce. The bulls had a nice couple days of upside action. But look at this RSI. This RSI got pretty high in the mid 70s for the first time after coming from oversold. And look at the volume. This hourly candlestick had the highest volume that we had seen in dozens of hours. It formed a bearish reversal candlestick, a spinning top up here. And then from there, we just were unable to break resistance, and then the bears took over with a spike in bear volume once this tight pattern broke down. So if you entered a bearish position at this candlestick and then watched it ride out a little bit, the volume climax with the RSI and the volume would have ended up playing out really nicely with a pullback if patient enough to hold for a couple days of action. On a shorter term time frame, if looking at day trades, here's Ethereum on the 15-minute time frame. So same thing. We're coming from oversold conditions. So when we're coming from oversold, the first time that we hit overbought, we generally look for a pullback. So here's a couple examples where we had a bull move with the RSI at 77 on the 15-minute time frame. You can see the volume is high here. Two candlesticks of very high volume right next to each other, and that's a potential climax indication. So if you made a bearish entry there, we pulled back, we formed a lower high and a lower low. So that gave some short-term opportunity. And worst case scenario, that's the kind of trade where you can eventually put your stop loss at break even, and it would have potentially stopped you out when the bull saw continuation. But it's putting yourself in favorable setups and allowing yourself to protect your trade and say, okay, if I'm in a break even stop loss and we continue to pull back, you know what, that's the most comfortable position that you can be in. So ended up, we did get another bull move up, another climax. The RSI broke 80 this time with very high volume. It was the highest volume we've seen in hours, and it was over the volume that we saw in the previous climax attempt. So here, another example where if you entered a bearish position, the pattern tightened up, it made a clear bear break, and then we saw bearish action over the next couple of hours, maybe the next day or so, and the price pulled back pretty significantly from that bearish entry. So again, just like we look for oversold dumps and volume climaxes for bullish entries on bounces, the bears look for overbought climaxes, high RSI levels, high volume, and unsustainable moves that allow them to enter the bearish position and to allow for a potential flip on that pullback. So now we're going to look a little bit more in depth at 4 different bearish trade entry opportunities that we see play out time and time again.